Meet Ryan. Ryan has been in the markets for about 24 months. In finance time, that's roughly the experience level of someone who just learned what a candlestick chart is yesterday. This year, Ryan's portfolio is up 18%. He caught a random AI stock before it went viral, flipped a meme coin for a quick double, and now refers to himself as macro-aware. Ryan's daily routine: scrolls finance Twitter before brushing his teeth. Explains inflation at parties. Says things like, "I'm mostly in high-conviction plays." Naturally, Ryan decides he's ready for the big leagues. So he does what every overconfident beginner eventually does: applies for options trading. When the brokerage asks about experience and net worth, Ryan suddenly becomes a seasoned investor with advanced knowledge of derivatives. Approval granted. Fast forward 2 months. Ryan is fully leveraged into out-of-the-money calls on a hot tech stock that hasn't turned a profit since 2016. His strategy? Momentum. His risk management? Optimism. His explanation for every red day? Short sellers. Then interest rates tick higher. The Federal Reserve tightens policy. Liquidity dries up. Ryan's portfolio? Down 61%. Suddenly, he's less macro-aware and more macro-confused. So here's the real question. Why do inexperienced investors look brilliant during bull markets? The answer lies in something called the Dunning-Kruger effect. This psychological bias explains why people with limited knowledge often overestimate their ability, while experienced professionals tend to underestimate theirs. In investing, this creates something fascinating. The least experienced participants can look like geniuses, temporarily. Let's zoom out. Since 2009, markets have experienced one of the longest bull runs in modern history. If you bought almost anything during major liquidity waves, tech stocks, speculative growth, crypto, high beta plays, odds were you made money. And when markets rise consistently, volatility works in your favor. This is where beta comes in. Beta measures how volatile a stock is compared to the overall market. For example, if a stock has a beta of 1.5, it tends to move 50% more than the market. If the market rises 2%, that stock might rise 3%. But if the market drops 2%, that stock could fall 3%. See the catch? High beta assets amplify both gains and losses. During a strong bull market, a portfolio full of volatile stocks will likely outperform conservative portfolios. And that outperformance creates confidence. Confidence creates risk-taking. Risk-taking works, until it doesn't. Here's what actually happens. In a rising market, aggressive portfolios outperform. Speculation is rewarded. Fundamentals matter less. Everyone feels smart. In a falling market, high beta portfolios drop faster. Leverage magnifies pain. Speculation gets punished. Blame gets assigned. It's not that bad investors are smarter. It's that certain strategies only look brilliant in specific environments. If markets trend upward for long enough, even reckless positioning can look like skill. But when conditions reverse, higher rates, tighter liquidity, slowing growth, volatility flips from friend to enemy. So why do inexperienced investors win? Because retail traders are naturally drawn to volatile stocks. Leverage.
Trend-driven momentum.
Story-based investing. And in bullish conditions, those characteristics outperform. But markets move in cycles. The same strategy that turns $5,000 into $25,000 during a hype cycle can turn $25,000 back into $7,000 when sentiment shifts. That's not genius. That's exposure. The real lesson? Everyone looks like a market wizard in a bull run. True investing skill isn't measured by how much you make when everything is rising. It's measured by how much you keep when conditions change. So next time someone brags about their latest 10x play, remember, in a rising tide, even the wildest boats float. The real test comes when the tide goes out.